prepare yourself, because you are currently witnessing the beginning of your neighbor's financial ruin. This isn't happening because they were reckless or made poor life decisions. It is happening because they fell for the same deception that has been aggressively marketed to the public over the last 4 years. As we speak, a catastrophic $12 trillion ticking time bomb is embedded within the American housing sector, and the fuse has already been lit. There is one specific statistic that should keep you up at night: 67%. That represents the portion of the typical American S total net worth currently trapped inside their primary residence. Imagine having your entire life as work stored in a single asset, all your eggs in one solitary basket, and then realizing that basket is being pushed toward the edge of a jagged cliff. Over the next 20 minutes, I'm going to reveal a reality that the mainstream media refuses to cover. It isn't hidden because it's a classified secret. It's ignored because it is so painfully obvious that acknowledging it would cause mass panic. This exact economic pattern has devastated the world 3 times in the last 100 years, and right now, we're watching it unfold again, frame by frame. Look at the data. In just 6 months, the U.S. Treasury was forced to absorb a staggering $23 trillion in mortgage-backed securities. During the third quarter of 2024, J.P. Morgan Chase aggressively offloaded 40% of its entire residential mortgage portfolio. Furthermore, in November, Deutsche Bank quietly disclosed $1.2 billion in losses specifically tied to real estate derivatives. These are not isolated or accidental occurrences. These are strategically choreographed exits. The smart money, the institutional giants, has already left the building, leaving you to deal with the impending wreckage. By the time we finish this discussion, you will understand the mechanics of this machine with perfect clarity. You will be able to identify exactly which stage of the collapse we are currently navigating, and you will see why 40 million people, potentially including yourself, are about to realize that their greatest perceived asset is actually their most dangerous liability. To understand our future, we must look at how the trap is set. Every single financial meltdown follows a specific blueprint that I refer to as the leverage ladder. It consists of 4 distinct stages that occur in the same sequence every single time. Stage 1 is the foundation. This is the period where everyone feels incredibly wealthy and successful. Prices for assets rise relentlessly month after month, and credit is so abundant it feels like water gushing from a fractured pipe. You see your neighbor taking out a cash-out refinance to buy a luxury boat. You hear about your cousin, despite having a dismal 590 credit score, getting approved for a $400,000 mortgage. During this phase, no one asks difficult questions, because everyone appears to be winning. Between 2021 and 2022, mortgage debt in the United States surged by 2.1 trillion. Make no mistake, that isn't genuine economic growth. That is raw leverage. It is borrowed optimism. And the fundamental truth about borrowed optimism is that eventually the lender comes back to collect. Stage 2 is the trap. This is where the situation becomes truly fascinating for those paying attention. While the general public is still popping champagne and celebrating rising home values, the insiders are already sprinting for the exits. If you examine SEC filings from the final quarter of 2024, you all find that CEOs from the top 12 mortgage lending institutions sold off 487 million of their own company shares. They weren't just diversifying their portfolios or preparing for retirement. They were selling because they see the same data points you see, but they actually understand the implications. Currently, interest rates remain high while home prices have failed to correct. That widening gap is the trap itself. Think of it like a pair of scissors. The blades are opening wider and wider, and your financial neck is positioned right in the middle. Stage 3 is the trigger. This is the moment when something finally snaps. Historically, the trigger is never the event that everyone is watching. In 2008, it was the subprime mortgage market, loans that were considered so insignificant that Fed Chairman Ben Bernanke publicly stated they were contained. In 1929, it was margin debt, which experts believed was too small to destabilize the entire global economy. The trigger is invariably something that the experts dismiss as being too localized or too minor to cause a contagion. That is, until it becomes the only thing that matters overnight. Stage 4 is the cascade. This is the phase where time seems to compress. The wealth that took 10 years of hard work to accumulate can vanish in just 10 weeks. This stage is defined by forced selling, margin calls, and the sudden disappearance of liquidity. It's like a water vanishing down a drain. At this point, your home is no longer worth what a website like Zillow claims it is. It is only worth what a buyer is willing to pay in a market where everyone is trying to sell simultaneously. And I can promise you, the price is significantly lower than you imagine. This isn't just a theoretical exercise. This exact chain of events has played out 3 times in modern history, and during each occurrence, millions of people convinced themselves it couldn't happen to them. Let's look at the evidence. Most people are familiar with the 1929 stock market crash and Black Tuesday, the images of bankers jumping from windows and endless breadlines. But history classes often omit a crucial fact. The Great Depression didn't actually start on Wall Street. It began in the Florida real estate market 3 years earlier, in 1926. Picture Miami in the mid-1920s. Speculation on land had reached a fever pitch. People were purchasing plots of swampland without ever seeing them. Developers were using newspaper ads in New York and Chicago to sell prime beachfront property to buyers who had never even stepped foot in the state. The business model was deceptively simple. You put 10% down on a lot and flipped the contract to the next speculator before your first major payment was even due. Everyone felt like a genius because everyone was making money. Then, in September 1926, a massive Category 4 hurricane decimated Miami. Suddenly, investors actually went to inspect the land they owned only to find a very inconvenient truth. Half of the properties were literally underwater. They weren't underwater because of the storm. They were naturally occurring swamps. They had always been underwater. The market collapsed instantly. Overnight, $1 billion in real estate value, which would be roughly $18 billion today, simply evaporated. But here's the critical part. Nobody connected the dots. The consensus was that this was a Florida problem and that the national economy was perfectly healthy. It wasn't. Those Florida land deals had been funded by small rural banks across the entire country. When the land value went to zero, those banks began to fail. By 1929, over 600 banks had already shuttered before the stock market ever crashed. The 1929 crash wasn't the cause of the depression. It was the final symptom. Real estate debt had already infected the entire financial system like a slow-moving poison. The stock market collapse was merely the moment everyone realized the patient was already dead. There's a detail from that era that should make your skin crawl. In 1928, a full year before the crash, wealthy insiders began moving their capital. J.P. Morgan personally transferred $60 million in gold to European vaults. The Rockefellers quietly shifted their wealth into treasury bonds. They saw the end coming. Meanwhile, the average homeowner didn't lose their house in 1929. They lost it in 1933. Banks began calling in mortgages early, not because the owners had missed payments, but because the banks themselves needed liquidity to survive. Your home wasn't your asset. It was the bank's emergency exit. Millions of people who paid every bill on time lost everything because the system collapsed around them. Fast forward 60 years to 1986. The Reagan era was in full swing, the economy was booming, and Wall Street was generating massive profits. Yet, 747 banks were about to vanish. The savings and loan S&L crisis is a collapse that many have forgotten because it happened so gradually. Much like carbon monoxide poisoning, you don't realize you're in danger until it's too late. In the early 80s, Congress deregulated these institutions. These were traditionally boring, stable community banks. Suddenly, they were allowed to make high-risk commercial real estate bets. In Texas, S&Ls funded massive empty office parks that had zero tenants. It was pure, unadulterated speculation. By 1985, commercial vacancy rates in the Southwest hit 30%. The most infuriating part is the smoking gun. By 1984, federal regulators were fully aware of the disaster. Internal memos from the Federal Home Loan Bank Board showed that nearly 500 S&Ls were technically bankrupt, yet they buried their reports to avoid spooking the market. They thought they could manage the failure quietly. That worked until 1989, when the dam finally broke, costing taxpayers $132 billion in bailouts. What the history books leave out is that over 1,000 S&Ls simply disappeared. If your mortgage was held by one of those banks, your loan was sold to a vulture fund that immediately hiked fees or initiated foreclosure. People who had trusted their local bankers for decades were suddenly being hounded by out-of-state collection agencies. Your own savings accounts were being used to fund the very bubble that would eventually destroy your financial future. The snake was eating its own tail. The only reason that crisis ended was because California and New York markets stayed hot enough to subsidize the losses in Texas and Arizona. The disease wasn't cured, it just moved. Now, let's look at the dress rehearsal, the 2008 Great Recession. We all know the headlines: Lehman Brothers, Bear Stearns, too big to fail, and foreclosure signs on every street. But there is a specific frame of that movie everyone missed. The 2008 crash didn't start with bad mortgages. It started in 2004 when the SEC made a seemingly boring change called the net capital rule. The banks knew exactly what they were doing. In 2006, Goldman Sachs created a CDO called Abacus 27AC1, specifically designed to fail. They sold it to their clients while simultaneously betting against it. When it collapsed, Goldman made billions, and their clients were wiped out. This is a documented fact proven in Senate hearings. When the crash hit, 3.8 million Americans lost their homes within 2 years, not because they were irresponsible, but because the system was fraudulent by design. The terrifying truth? is that we didn't fix the underlying issue after 2008. We just made the bubble bigger. The Federal Reserve dropped rates to zero and pumped trillions into the economy. That money went right back into real estate. We tried to solve a debt crisis by taking on more debt. Now, 16 years later, we are standing under a debt balloon the size of the moon, and the needles are starting to drop. Let me show you exactly where we are on the leverage ladder using documented reality. Stage 1, the foundation, occurred between 2020 and 2023. COVID-era mortgage rates dropped to 2.7%, essentially free money. Housing prices spiked 40% in 3 years. While a $300,000 house might be worth $420,000 on paper, the Atlanta Fed S Affordability Monitor shows that the median household now must spend 41% of its gross income just to afford a median-priced home. The historical sustainable average is 25%. We are 60% above what is sustainable. This isn't a healthy market. It's a Ponzi scheme running out of new participants. We are now deep into stage 2, the trap. In March 2024, the yield curve remained inverted for its 18th consecutive month, the longest in history. Every single time the yield curve has stayed inverted for more than a year, a recession is followed within 18 months, no exceptions. Then, in August 2024, Japan raised interest rates for the first time in nearly 2 decades. This matters because Japanese banks hold over $1.2 trillion in U.S. mortgage-backed securities. When they raised rates, the carry trade collapsed and U.S. mortgage bond prices plummeted 8% in 72 hours, the fastest drop since 2008. The Fed had to perform an emergency $80 billion intervention just to keep the market from freezing, an event that barely made the evening news. Furthermore, between now and the end of 2026, $1.05 trillion in commercial real estate loans are coming due. These are loans on half-empty office buildings. Default rates are already at 12%, triple the historical norm. When these buildings are eventually sold for pennies on the dollar, those losses will land directly on the balance sheets of the same banks that hold your home mortgage. The dominoes are already being positioned. The mainstream media is focused on inflation and unemployment, but the real trigger is lurking in the $210 trillion derivatives market. That is 8 times the size of the entire U.S. GDP. These are circular insurance contracts between banks. It works as long as everyone pays, but if one major link breaks, like Lehman in 2008, the entire chain explodes. On November 14, 2024, Deutsche Bank announced massive losses in real estate derivatives. This is the first visible crack in the dam. When a major bank fails to meet a margin call, credit markets will seize up. Since 90% of home sales require a mortgage, no credit means no buyers, and no buyers means a total price collapse. The Fed tried to prevent this by absorbing $2.3 trillion in securities this year, but the market is simply too massive for them to save everything. Here's your roadmap for how this unfolds. Domino 1, Q1 2025. Commercial defaults accelerate and mid-tier regional banks in cities like Phoenix and Nashville begin to fail. Digital bank runs happen at 2 a.m. via smartphone apps. Domino 2, Q2 2025. Credit card defaults, already at their highest since 2011, spike further. When people can't pay their cards, the mortgage is the next thing they stop paying. Domino 3, Q3 2025. Forced selling begins. Homeowners from 2021 who have zero equity will find themselves underwater if prices drop, even 10%. Many will simply walk away. Domino 4, late 2025 to early 2026. The cascade. National prices drop 20 to 30%. Lending freezes completely. 40 million homeowners realize they are trapped in an asset they can't sell, can't refinance, and can't afford. You might be telling yourself, this time is different. Those are the 4 most dangerous words in finance. People say the banks are more regulated now, but Silicon Valley Bank passed its stress test just weeks before vanishing in 48 hours in 2023. Regulations can't keep up with the speed of internet-driven bank runs, and they don't even cover the $52 trillion shadow banking system. You might think homeowners have more equity now, but 63% of mortgages since 2020 went to first-time buyers with minimal down payments. A 15% price drop wipes them out completely. Plus, corporate investors, who now own 7% of houses, will liquidate the moment the market turns, accelerating the crash. Finally, don't count on a government bailout. In 2008, it cost $5 trillion. Today's debt market is twice that size. With a $36 trillion national debt and a $2 trillion annual deficit, the math for another bailout doesn't work. They can't print enough money to save the housing market without destroying the dollar or causing a political revolt. This time isn't different. It's actually worse. Every debt-fueled bubble pops when the cost of the debt outweighs the return on the asset. We have reached that point. Here is your survival plan. First, determine your true loan-to-value ratio. Forget what Zillow says. Calculate what you could get in a 30-day fire sale and subtract 10%. If you owe more than 80% of that value, You are in the danger zone. Second, build a 12-month liquid cash reserve, not stocks, not crypto, actual cash or treasury bills. Third, stress test your income. If you lost your job, how long could you pay the mortgage? If it's less than 6 months, you need to cut expenses or sell now. Fourth, if you're staying for the long haul, open a HELOC immediately while banks are still lending. You need that line of credit as a safety net before they disappear. Fifth, if you are stable, prepare for the opportunity of a lifetime. Crashing markets create generational wealth for those who have cash when everyone else is forced to sell. The Fed doesn't care about your house, they care about the system. If they have to sacrifice your equity to save the banks, they will do it in a heartbeat. The math demands that this leverage unwinds, and the bullet is already in flight. The only question left is, are you going to stand in its path?